Hello, everybody. Sorry about the delay. We had a little technology problem there, but we're getting started here now. Today we have, I'm going to be doing a program on investment basics. So happy to have you here joining us today. This is a Financial Wellness Fridays at 11 o'clock. And just a quick brief overview. Obviously, we've got our disclosure there, so please feel free to read through that. You can also see that on the COPEC website down at the bottom. There's a full disclosure there as well. And so appreciate the chance to do this program for you. Great. And then again, there's my information. If you need me directly for any reason, feel free to reach out. And then this is the financial wellness portal that I was just talking about, with the different slides, and hopefully you've been able to see these before. But if you have any questions, definitely just reach out whenever you have a chance. And this is an example of just one of the calendars for the Daily Show. Feel free to check those out, and if you, including the Financial Wellness Fridays, check those out and let us know if you have any questions, or just tune in, and we're happy to have you. So I'm going to switch over here to my program. And let me do that real quick. And there we go. Hopefully I did that right. So what we're going to talk about again is the investment basics. And my hope is that we can give a pretty good feel as to what some of the basic understandings that we need to really look at when you want to review and build your investment portfolio. So without getting too deep, I want to make sure that you also can ask any questions or concerns as we go along. We have plenty of time for that. I assume this will probably be about 40 minutes to get through this. One of the main things I like to talk about, and just make sure it's really clear, is we talk a lot of time about the difference between speculating and saving. And why there needs to be a differentiation between those two. Really, when you deal with investments, you're, just as it says right there, it's a combination, carefully planned and prepared approach to managing and accumulating money. So the higher, the higher logo there, the speculating, is there is long-term statistics that show stable performance over time and predictability. And then there is short-term volatility within sector stocks, whatever it might be, that you could really fall under the category of speculating. Down below, savings can be broken up into two different categories, really. You could talk about savings in the sense of the verb, the act of savings, which is obviously very critical, but also the idea that it is a very conservative investment vehicle, like a bank account or something of that nature. The idea of managing and accumulating money is a combination of those two, and it really has to do with human behavior, to make sure that you do the right actions to not only put the money in the account, to allocate it the proper way, to manage your human behavior so that you don't make wrong decisions at the wrong time. And together, that long-term platform gives you the comfort level and confidence to know that when you put your money away in a proper investment portfolio, that not only is it going to be there for you in the future, but that you get the rate of return that is commensurate with the risk that you're exposing yourself to. So a couple of things. First of all, the risk of inflation. Most of the times when we talk about investment portfolios, we look at the number one goal is to meet at least the expected inflation rate. So if you have $1 today and it can buy you an item that costs $1, well, tomorrow, that item will go up at the cost of inflation. So if it's $1, next year you need $1.03 to buy the exact same product. So that means your investment, if you're not spending it and you're investing it, you want that dollar to grow by 3% to meet that inflation increase. Otherwise, the value of that dollar decreases over time. And so maybe in 20 years, if you have a dollar still and you put it in your mattress, well, in 20 years in general, that product that cost $1 now is going to cost $2. So you're 50% where you should be to buy that same product. This happens to people all the time, especially when you project out for long-term, like retirement and things like that. Hey, I'm living on my income right now really well. But if you don't have that resource, the investments or wherever you're getting that income coming from to grow over time, that inflation is really going to be impactful. So what this is doing here is if you take a look at the 200,000, well, in year 20, that $200,000, the purchasing power is as if it went down to 108,000. And then in 40 years, and this is at a 3%, so just a basic 3% inflation rate. And then in 40 years, it's actually worth the purchasing power at 59,000. It'll still be 200,000, but it just costs you so much more to buy the same products. A lot of times people talk about the idea of I'm a millionaire. Well, if you would have said that in 1960, that's a big deal. And I'm not saying it's not a big deal today, but it's less of a big deal compared to 30, 40, 50 years ago. And, you know, now there's many more millionaires out there just because you need, and, you know, the ability to save at a higher amount, the cost of homes, all of those things. So inflation is really a big key, and you want to at least stay square where you're at and not lose ground. The other is, you know, this is a concept with investing, and this is the benefit of compounding. So if you have a goal to grow your money over a number of years, I want you to take a look at the back end of this chart. So at the beginning, from years 1 to 3 to 5 to 7 and 9 years, you notice that growth rate is relatively flat. And that's because it hasn't had time to earn money on its own interest. But over time, when you start seeing it getting more vertical, so it's actually growing faster, and that's primarily because you've been able to grow the money on top of your own money. So when you take a look at this, it's very important to make sure you look at how much time you have to dictate how much money you need to invest into those investments to reach those goals. But if you can give it time, that compounding benefit is really powerful. Now, the other thing about this, especially if you use it inside some of your retirement accounts, like an IRA, 401k, 403b. Excuse me, I got the yawns this morning for some reason, my apologies. But if you have these retirement accounts where you're able to put money in on a pre-tax basis, not only are you able to compound the benefit of those returns over time, but you're also now putting in the effect that you're using what would have normally been spent in taxes. You're using that money as well and compounding on top of that. So let's say, for example, you make $100, but you pay 20% in taxes. Well, if you put $80 in a plan versus $100 pre-tax, well, you can more quickly get that compounding effect happening because you have an extra $20 in there, which means you're getting whatever rate of return on that extra $20, which is added to the value there. Then in the future, you got to pay that 20% back, of course. But hopefully you benefited from that compounding along the way. And then just as a note, you know, investing sooner is always better if you can. Obviously, we've got so many responsibilities in our lives that we got to deal with. And, you know, we've got paying off debts and buying a house, and starting a family, and all kinds of things that we have to deal with. And so the hope is that if you were to delay your savings from, let's say in this example, from 20 years, age 20, and you have to defer to 35, let's just say. Well, hopefully the assumption is that instead of putting away $3,000 per year, you're going to be putting away more like $10,000 a year. So to some degree, of course, you expect a higher savings rate to make up for not starting early. But here's the issue. If you're able to start as early as possible, take a look at what $3,000 put in annually at a 6% growth rate, which is very easy for anybody to do and reach that 6%. But if you started at age 20, that age 20, look what it does in the last years at age 55 to 60. Remember we talked about the compounding benefits? So from age 20 to 35, that's 15 years. 15 years at $3,000, so $45,000 less from just those 15 years. When you look at it at age 65, it's over $400,000 in difference. It is a dramatic benefit to go ahead and get that extra money in as soon as possible, even if it's a small amount. Obviously, $45,000 today versus what it's worth in the future, but let's say it's worth double or triple. You're still at 150 versus the 450 that it grew to. It's a dramatic impact, and it's very valuable to get that going as soon as possible. Basic fundamentals of investing. When you look at the goals that you're trying to accomplish, that's really key. Most people ultimately want the goal of retirement to be a comfortable retirement, and that's always weighing on everybody. But obviously, you've got more shorter term goals, things like education, special purchases like a home, a car, a business. Maybe, sometimes people like to save to start a family, which I think is incredibly important. And think about like buying a home. Obviously, when you buy a home, you want 20% down. Maybe you can do it for 10, maybe you can do it for 5, but, talk to your lender as far as what that goal is. But then also remember, you don't want to buy a home and not have money for an emergency fund in case the roof goes out. What about furniture? All those types of things that you want to do, that is also part of that goal. So you kind of do a needs assessment of whatever your goal is and whatever you're trying to accomplish. And that allows you to bring that into an amount that you can set your goals for. Short-term, long-term, and then obviously working with your time horizon. The longer out you are, the more that you can take risk, which you can bring that rate of return up from 3% to 6%, or maybe even more, depending on your risk tolerance. And so it's real important to take a look at those goals, time horizons, and let that dictate what kind of investment portfolio and strategy you're going to put into place. And I know that we talk a lot, about planning. Nate on Thursdays, we talk a lot about planning and tying the planning in with the investment portfolio and these goals. And so they really work hand in glove to make sure that you have those tied together to be accurate. A lot of times people say, like when we have market corrections, how are you guys handling this? Are people panicking? Well, in general, no. And not that people don't like it, when not that people like it when the market goes up and down and it's volatile. One, we know it's going to be volatile. It doesn't matter when you go and what time frame. There are times in our investment history where it is volatile and it's going to happen. But if you accept that as part of your investment strategy and you understand what kind of volatility you have based on different accounts, it's part of the deal. It's like driving a car. At some point, you're going to have a flat tire. At some point, you're probably going to have an accident. These are risks that are, innate risks that are tied into that action, and the markets are the same. And then you got to find out if you're comfortable with those fluctuations. But as long as you are and you understand it, and you believe that the long-term market and the economy is going to be stronger in 5, 10, 15, 20 years down the road than it is today, you're able to get through that volatility a little bit easier. And then we talk a lot about panic points. We don't want anybody to be in a point where they panic and they make the wrong moves. So let's say, for example, that you understand there's volatility, but to you, volatility is going up and down 5%, not 40%. Well, for that person, we want to set up a portfolio that they never go past that 5%. I mean, obviously it can, because you can never predict the future, but you set it up so that predictably, in its worst, scenarios, that it doesn't go down more than 5%. And if it does, it's one of those unique times that do happen from time to time, but it allows you not to sit there, oh my gosh, I got to sell it. And if you sell it, you basically captured loss and you did not get those gains in the return of the market. And it just really makes it difficult to reach your goals. Back to the risk tolerance here. It really does break down the ability of the investment plan to absorb the loss. What is your ability to go with those pressure points? And we'll break that down in a little bit. I kind of talked a little ahead there, but so investment, potential returns and risks. I want you to take a look at that bottom right, stability, growth, and income. So obviously with stability, that's a little bit of, it's going to be there. It's safe. It's predictable. It doesn't have a lot of volatility. So a lot of people might be looking for something like that in their investments. You would imagine if you want stability, you're probably going to give up on rate of return, income, or growth. And then the other one, growth, you might lose stability and you're probably going to lose income, but maybe you might get a stock or something that might grow from 5 to 50. A lot of times when you look at the market returns on the TV, they're not talking necessarily about dividend price, value. They're looking at the stock prices, ups and downs. And usually those are based on what kind of predictable dividends they might be getting. So, and then the other is income. Those are dividends, bond returns, payments from fixed accounts, things like that, where you're not selling the vehicle, but they're paying you an income either as an owner of a stock or an owner of a bond in the form of a coupon payment. And so the idea there is you really have to be careful, and you have to understand that there really aren't investments out there that have all three of these. You have to pretty much give up on one to get the other. Yes, some of them have, growth and income funds where you get a little bit of growth and you get a little bit of income and it brings back in a little. So there's shades of gray here, obviously, but you can't get great growth, but also great stability. They shouldn't be paired that way, because that's the whole point of a growth, is that you're taking that risk, and with that risk innately comes the volatility that comes with those markets. So on a scale, we talk about different types of investments: treasury bills, CDs, and I would argue treasury bills and CDs, you can include bank accounts, right? Bank accounts really, quite honestly, is the most secure, lowest return. So it's down below the treasury bill, really. And just make a comment on that. If you have a small emergency fund or your cash flows, absolutely use the savings accounts. If you're extremely conservative, you can still get into these treasury bills, CDs, even some government bonds with very low volatility. Sometimes it'll move around here and there, but that can still allow you to get up closer to some of those inflation rate returns that remember we talked early on, that you really want to be able to meet so that you can protect your dollars. Because if you're not exposing yourself to a little bit riskier, now you're dealing with what's called inflation risk, where every year, back to that 3%, if you've got $1 and it's now worth 97 cents, well, that's a very real risk. You lost 3%. Just like as if you have it in the market and you had $1 and the market dropped to 97, Inflation risk is exactly the same. It's just the eating away of the purchasing power versus the actual dollar. So you really want to meet that 3%. And if you're real conservative, you need to find a portfolio that gives that. Obviously, with current interest rates being really low and with the bond rates being really low, it's harder and harder to do that. And you hear all the time about seniors out there that are really struggling because the interest rates are so low that they can't even keep up with inflation sometimes. And that's also one of the reasons why the market is doing well, because to offset those interest rates, they are looking towards some of the more volatile pieces to make that up. We hear interest rates are great, but they're great if you're borrowing. They're not as great if you're investing or you're the lender, meaning if you put money in a bank, you're lending it to the bank and they're paying you back at a very low rate. So it's real important to make sure that you look at the values of interest rates on which side of the ledger you are. Are you a lender or are you a borrower? And most people in retirement, they're the lender. So they're waiting for the money to come back. But if you're buying a house, a car, or any of those things as a borrower, then low interest rates are great for you. Then we get up to different areas: corporate and government bonds, preferred common stocks, and options and futures. Options and futures, I would highly recommend that if you get into that area, you really are an advanced investor. You're taking risks, and the volatility exposure that you have there is really pretty strong. Common stock and preferred stock, a lot of people get there. Usually they do it in mutual funds or index funds, those types of things. So they diversify that out and make sure that you get rid of some of that single stock holding risk tolerance. And then obviously the corporate bonds. Some alternatives for cash. You got cash alternatives. Those are, like I said, the bank accounts, bonds. I'm sorry, these are types of investments. We talk cash, bonds, stocks, other, and even under other alternatives, real estate, things like that. And then funds, again, mutual funds. The idea is instead of buying one stock, GM, let's say, now you buy a number of stocks within a portfolio, and it's diversified. So you're not taking the risk of one individual account stock. You're taking more of an investment in a portfolio and a broader understanding of sectors and the market as a whole. And a nice note here: 401k plans, IRAs. Please understand that those are that terminology is a titling. It's a tax code. It's not an investment. So you may have an investment like a stock or a bond inside the title of a 401k or inside the title of an IRA, Roth IRAs. But if somebody says, "Hey, do you have any investments?" "Yeah, I have an IRA." Well, then the second question would be, "Oh, you have an IRA. That's great. That's a tax benefit account, a tax advantage, tax deferred. How is it invested?" "I don't understand." "Is it in a stock?" You see what I mean? So a lot of times people confuse those two. So stocks, bonds, mutual funds, those are investments. 401k, IRA, Roth IRA, 403b, those things, those are titling of how the tax code treats the contributions, growth, and distributions of those accounts. So real quick, cash alternatives, low risk, short term, very liquid, great for emergency funds and cash accounts and things like that. CDs, money markets, mutual funds that are money market mutual funds, and treasury bills, T-bills. Those are the levels that, in essence, you're going to get a really low rate of return, but you're also going to get that stability that we talked about before, that, it should be there tomorrow. But again, you have the risk of inflation risk if inflation is higher than what you're getting as an interest rate on these accounts. And then some advantages: predictable earnings, high liquidity, liquid risk, or little risk to principal, but they have low returns, may not keep. So exactly what I just said right there. Bonds. These are loans. Again, if you go ahead and buy a bond, you're lending the company money. Now, whether you do it direct with the company or you buy it on the secondary market, ultimately somebody lent that money. So if investor A, did $10,000 with a company, but they later sold that note to you on the open market, you purchased it from the other one, but ultimately that money was invested in that company. And they pay a rate. So instead of them getting a loan from a bank, they may issue bonds and investors invest, and that's essentially the same thing. It's a lending instrument. You don't own shares of the company. You've lent the money. And interest is typically paid in regular intervals. Those are coupon, and then the yield from that is based on what the valuation is, time to maturity, things like that. Types of bonds, again, U.S. government securities, agency bonds, municipal bonds, and corporate bonds. Municipal might be a locality that is trying to build a road or a bridge or something like that. Corporate bonds, you're looking at the corporations, and there's highly rated and lowly rated, high yield they call it. They could be considered junk bonds because there's a higher chance of default that they won't pay those back. So you have to make sure that you measure those and you look at the risk and return based on each exposure to that risk, not just of getting paid back, but also the volatility and how it is impacted by adjustments of interest rates that are available out there. And then stocks. Shares of stock represent an ownership position in a business. You own a share, and that percentage determines your profit and loss. Earnings may be distributed as dividends. So you might have that situation where you have a stock that's worth $10 a share, and it only goes up to $11 over 5 years, but it paid out really good dividends. That might be a very attractive stock. Or it pays very low dividends, but it went from 10 to 20. Now, you don't have cash to really spend because the only way you can get that money out is by selling it. But your net worth, the value of it has grown, and there's a lot of value in that. There's a lot of tax rules as well that are differences between how stocks grow in an IRA, it's treated as ordinary income, or how dividends are treated when they are paid out, or capital gains, depending on when and how you sell those. So you want to, depending on your situation, you may want to buy certain stocks in your IRA, but you may want to buy different stocks outside where they're taxable because of the tax benefits. So there's a lot of different ways to look at those and put them in the right accounts, let alone your risk tolerance and what the goal of those investments are to be used for. Some general types, common versus preferred. Several of the things, when you deal with stocks and bonds, if the company was to default or go bankrupt, bonds get paid back before stocks. Common and preferred get paid back before common. There's a number of ways that they categorize each of these internally. So there's a lot of shades of gray many times out there of what you're looking at. Categories, small cap, mid cap, large cap. Obviously a small cap, I mentioned the $10 a share. Maybe a small company can grow a lot faster. So you might buy in at $5 or $10 a share, but it might grow to 50. That might be a small or a mid cap. But if you buy a stock at 100, chances of it going from 100 to 200 is a lot less than a smaller mid cap going from 5 to 10. So being aware as to what kind of growth you're looking at and what kind of stability between, small, large, and mid. And then growth, value, income, blue chip, American depository receipts, which is a way of dealing with international. You've got a number of different ways that they're categorized. And like I said, growth, then value. Well, some mutual funds, they put those together where they want growth and dividends at the same time, which is really what the value is looking at or the income is looking at. So some advantages historically have provided the highest long-term total returns. You get ownership rights. If you own individual stocks, you could actually vote. If you're a mutual fund, you usually defer that over to the fund company to make those votes. Can provide income as dividends as well as capital appreciation. They're really easy to buy and sell as long as they're traded on the most common open markets. Disadvantages, you could have poor company performance that affects how you're going to produce there. But again, usually, you're taking those risks, so those are still going to be higher than what you're in a low returning savings account. Subject to market volatility, of course, and you want to take a look at some of the historical. I tell people a lot, if you're going to buy a mutual fund, especially mutual funds, because it's a little bit easier to evaluate those, take a look at how it did in 2008. Or how it did earlier this year, or some of the other bumps in the market, and compare it to others in the same industry. Did it do poorly because the manager was just a bad manager, or did it do poorly because the whole market or that sector or that industry did poor during that period of time? And get a comfort level as, could you feel comfortable with that in that shorter period of time? And that shorter period of time could be 2, 3, 4 years. Doesn't mean it's only a month or two. We're kind of spoiled that we want immediate satisfaction to a degree. And even this year, the market recovered. As far as a market recovered pretty strongly. We're waiting for the full economy to come back with jobs and things of that nature. But markets are usually a precursor of what people think it's going to be. Obviously, greater risk to principal. And many times is really not appropriate for short-term investments. There's just too much risk that if you put in 10,000, it could be worth 5, in 6 months. Now, if you're given 3, 5, 10 years, it's very highly likely that if it did go from 10 to 5, that's a short-term dip, and it usually is going to recover pretty strong and make it through that and get an average over that period of time. The other investments, you got real estate. Some people like to buy rental homes, stock options. You can actually buy options that give you the opportunity to buy the stock at certain prices. And, so if you buy an option at $50 a share, and the stock goes up to $100 a share, well, you paid a certain amount for that right to still go back and buy it at 50, which means you've got a $50 gain built in, but you didn't have to buy the stock. I mean, it's an interesting way to do it. Some people sell those because they get the premium. I'll sell it to you for a premium. I get to keep the premium. As long as you don't exercise it, I get that money no matter what. But it's really risky, so you got to be careful about that. Futures and commodities like gold and silver and things like that, and then collectibles. Some people, buy collectibles, cars, paintings, art, whatever it might be. So there's other ways to invest as well, other than the standards, stocks and bonds. And mutual funds, again, it's pooled money. A lot of people put their money together with one manager, and that manager goes out and invests in a portfolio, and you own a percentage of that portfolio, which indirectly you own the stocks inside there. You're exposed to those. I always like to explain it kind of like a business. You buy a share of a business, and that business's goal or job is to invest in stocks. So you own a share of the business, but not directly the products inside, which is the individual stocks. But it's a great way to diversify your portfolio. The money manager buys and sells based on what they think is going on in the market. And then you evaluate it every 1 to 3 years on how their performance is compared to their peers and things like that. And to set up an overall portfolio, you want money managers that might be really good in different areas. Maybe in your portfolio, you want 15% in large cap stocks. Well, you buy a mutual fund that's managed as a large cap stock exposure, and then as long as they're doing a good job there or not, you might get rid of this manager, get a different manager, but you want to stay within that large cap stock realm. let's say you want to get out of there and go into a mid cap. Well, then you'd sell that manager and you buy a manager that is specific in the mid cap range. And they put a little disclosure in here. Investors should carefully consider the fund's objective risks and charges expenses. There's a lot of variables in investing to make sure that you get a good rate of return. A lot of times people, they don't think about this, where the expenses and the human behavior and the taxes and all that stuff, all of a sudden you think you're doing really well, but these pick at it. And, you might have an 8% rate of return, but when you're done, you might have 4% because of the way you were taxed, or the way, you might have excessive fees. There's just a lot there. And I highly recommend anybody who has investments, whether it's a 403B, IRA, mutual, again, categories, however you have it. That's an interesting point that I want to make right there on fees. There are two kinds of fees. There's investment fees, and then there's the provider fees. So if you have a provider that is giving you, let's say a 401k or 403b, they have charges before you even get to the internal investments that also have charges. So sometimes you got to be really careful to evaluate all of those fees, because if you don't do it right, you could be spending anywhere from 2 to 3% on fees before you even get the full return on the investment. So just be aware of that, and you understand the fees, taxation, all of that stuff, so that you've got a good understanding. Sometimes fees are very valid. If I have somebody who is investing in emerging markets halfway around the world, I kind of want the fees to be higher, because I want them to go there. I want them to research and do those things that it takes. But if I'm in an index fund, I don't want high fees, because it's an index fund. They track the index, and there's not a whole lot of work to do in there. So some fees are warranted and some fees aren't. And the mutual funds, they can handle all these realms. So, you can get a balanced fund, you can get lifestyle funds, you can get bonds and money markets and international. And so mutual funds are a great way to do that. And again, mutual funds in general, diversification, professional management, you don't have to put in a lot of money to get those accounts. And some of the disadvantages I mentioned before is they can fluctuate regularly. Your money could be tied up in cash for liquidity needs, which, if you go ahead and put $10,000 in a mutual fund, 3 to 6% of that could be in cash. So sometimes you think you have all 10,000 invested, but you really only have 9,500. May not sound like a lot, but if you do this across the board and you grow, your portfolio. Whereas if you use an index fund, you might have less because of its tracking. And a lot of times we tell people to build that in their understanding. So when we do evaluations, we actually break out that cash as part of their portfolio overall average. ETFs are basically exchange traded. They're very similar to index funds, but they're actually traded like a stock. So they might be a little cheaper. You can actually get in and out of them more quickly than mutual funds, which are actually settled at the end of each trading day. So if you wanted to buy one at 10 o'clock and sell it at 11, let's say, or actually sell it at 11 because you like the price. If it was an S&P ETF, you sell it at 11. But if you were in a mutual fund, you wait till it settles at the end of the day, which could be different. Most people, that's not a big deal because they're not looking at these things on hour by hour, even day by day. So, and just another issue with dollar cost averaging, make sure that you understand what dollar cost averaging is. It really helps you feel comfortable with the volatility while you save for retirement. I personally don't think people should worry about the market for 10 years if they're under the age of 40. And what I mean by that is every day the market drops, you're buying in at a lower price. that's good. As long as you believe in 10 years, it's going to be at a higher price. So you see there in the example in January, the price was at $30, but then in February it dropped to $10. Well, I'd rather buy in at $10 than $30. So I'm actually less worried about my net worth short term than I am towards the back end of my goal, which is either retirement or whatever it might be. So sometimes changing the way you think about it, like if you wanted to buy a coat and it's on sale, isn't that a good thing? So yes, the money that's in there also went down, but again, it should be temporary. And so, you're buying it at those low. And if you don't sell the other ones, it's a temporary paper loss, but you got to be careful. Sometimes losses it's just volatility, but sometimes losses, it means that the investment's a poor investment. And so you want to look at those and evaluate it all the time. And then some, asset allocations, diversification, risk tolerance, time frame, personal financial situation, liquidity needs. Those are all used in the allocation of what you're looking at. And here's sample allocations. If you're conservative, now there's two kinds, in my opinion, two kinds of conservative. There's I'm really conservative, meaning I have to have everything in my mattress or everything in the bank account, and I'm not investing any of it. That's ultra conservative. But if you're investing the money and you're dealing with some volatility and you're comfortable with that, then a traditional conservative model might be 50% bonds, 25% cash, and 25% stocks. That gives you that stability. It levels out the volatility. You get some growth with the 25% stocks. The bonds give you a little bit higher income, what the cash does. But having 25% cash, that means you've got money that you can use at any time in case you have those needs. This is an example of somebody we might set up who is in retirement. They're kind of conservative, but we want to beat inflation. Or if somebody that's just starting out and they just don't know what their risk tolerance really is, this might be an okay place to start. If you're a little bit more comfortable with the market, really that idea of a 50-50 exposure, decrease the cash, increase the bonds in the sense of comparison to cash, but still it's only 40% instead of 50% on the previous. See that? 50%, now it's 40% because stocks jumped up to 50% as well. This here is really, if a lot of people just don't know, but they think, yeah, I'm comfortable with market volatility, I get it. This is a great place to start. And then you tweak up or down from here, because this gives you that broad stability. The bonds hopefully can elevate the stocks when they're doing poorly, or the stocks can elevate the bonds and give that long-term allocation rate of return. This is a great place to be. You're going to get a little bit lower rate of return than if you're more stocks, obviously, but it keeps you in the game. And many times you just got to stay steady as you goes. And this is a great place to do that. And then this is more of an aggressive where you might have 75% stocks. This is for somebody that is just, you know what, I get it. And I really want to try to get a higher rate of return. I'm not going to touch this money for 10, 15, 20, 30 years. And I feel comfortable that, historically, and I'm not worried that if I have 100,000 that temporarily it might be 60,000, if we have a 2008 or even a, volatile, COVID situation, because just as quickly as it went down, it quickly can come back. And over time, I can get these higher rates of return. And so, this for people under the age of 40 is very popular. You might be very comfortable. Now, I don't like portfolios generally being 100% stocks or 100% fixed. I really like that 20 to 80 or 25 to 75 range. Most people should be inside those ranges. As a role of a financial professional, this is not to promote us or anybody individually, but have somebody who's independent and understands the market and can be a great sounding board. Think of it this way. Every company has an investment committee, or they have an investment advisor on making sure that they're making wise decisions, a committee, whatever it is. Make your own committee of your own. whether it's 10,000 or a million, it doesn't matter. Have somebody to challenge you, to educate you, to, if you want them to watch it and guide it. Think of it, buying a home. Whatever you do, you want somebody to give you that guidance. Just having an advisor involved can really give you multiple percentage in returns over time, because they're helping you stay out of trouble, they're helping you maximize, they're helping you minimize expenses, and just a number of things, let alone that somebody else is keeping an eye on it with you. And then, so that's pretty much the program today. That was a good overview. I have some time here. If anybody has any questions or comments that they want to throw out, I'm happy to go ahead and answer those as best as possible. Let me take a look. My apologies, I didn't have the chat on here, so I'm going to take a look at that. Okay, nope. So no questions. If you have any needs, this evaluation form is from another presentation, but just reach out. We're happy to provide any advice, one-on-one consideration of what goals you're looking at and discussions. There's a calendar where you can sign up or just reach out directly. Again, there's no cost to have brief discussions and guidance. Just let us know. But thank you so much for listening in, and hope this helped, and hope you have a great weekend, and we'll talk to everybody soon.